Well, good afternoon, folks. Just while we're waiting for participants to jump into the presentation today, this is the second of our Friday finance sessions. These are going on because we want to make sure that all of you who are tuning in can get back your legitimately entitled tax refunds. And we're going to be hearing today, hopefully, some tips on what you can do to maximise your refund check. All legally, of course, because it's important as the cost of living continues to increase and we're facing those extra charges that we can get as much money as possible back from the tax office. My name is Barry Elvish. I'm the CEO of AusActive. It's my pleasure today to introduce Mark Chapman. Now, Mark is the author of Life and Taxes, a look at life through tax, and has edited and updated the second, third and fourth editions of Australian Practical Tax Examples. He's got over 25 years experience as a tax professional in both the UK and Australia, specialising in tax for small business and individuals, which is us. He is a fellow of the Institute of Chartered Accountants in England and Wales, a fellow of CPA Australia, and a member of the Chartered Institute of Taxation. He holds a Master of Taxation Law at the University of New South Wales. So I think we can assume what Mark is going to share with us today is top of mind, most up to date, and covers all topics. Since 2015, Mark has been the Director of Tax Communications with H&R Block Australia. He writes regularly on tax issues for numerous media outlets and presents on topical tax topics at seminars and other events. He broadcasts frequently on radio and television and writes a regular column for The Money magazine and Yahoo 7 Finance. As a tax practitioner in the UK, he occupied a number of senior positions before moving to Australia in 2007 to join the Australian Taxation Office as a senior director. So Mark has had experience and knowledge on both sides of the tax cycle, I guess. If you have any questions, please post them in the Q&A box and we'll get to them at the end of the session. But for now, I'd like to hand over to Mark and away to you, Mark, and I'm looking forward to hearing how I can maximise my tax return. Thank you, Mark.
Okay, thanks, Barry. Good afternoon, everybody. Can I just check that you can all see the slides before I launch into this? Yep, okay. We're into June now, so obviously we're in the end of financial year, so we're very much in that position where our minds are turning towards tax, hence this particular session. Let's start with the basics. Obviously, you need to lodge an income tax return every year. If you're a self-lodger, so if you lodge your tax return via MyTax, that's got to be submitted by the 31st of October. If, on the other hand, you use a tax agent like H&R Block, you have a much longer lodgement deadline, potentially as late as May the 15th next year. If you don't currently use a tax agent, you've got to be registered with that tax agent by the 31st of October in order to take advantage of those late lodgement, those late deadlines. What goes on the tax return? Well, basically all of your income needs to be reported on your income tax return. So not just from your jobs in the fitness industry, but including any second jobs that you might have, any business income, including the sharing economy, any investment income, so rent, dividends, interest, etc. It all needs to go in your tax return. The income side is obviously very crucial for the ATO, but also the deductions that you can claim are also going to be crucial in terms of reducing that assessable income. So expenses which are incurred in your job will be allowable as deductions against your taxable income. And I'll talk about what kinds of expenses you can potentially deduct over the next few slides. I also just want to mention residency. It might not be relevant because I assume that most of the people on this this webinar are actually Australian resident. But if, for example, you are not Australian resident, you're taxed in a different way. You're taxed at potentially higher rates. And in addition, you are not taxed on any foreign income or gains. You're only taxed on Australian sourced income or gains. There could be some people on this webinar who are actually temporary resident. So people who are here in Australia on a temporary resident visa. Temporary residents are also taxed slightly differently. They're taxed at Australian tax rates, but in addition, they are also not taxed on their worldwide income and gains. You're only taxed on your Australian income and gains. I'm not going to go too much into that, but if you think you could be temporary resident or foreign resident, then do speak to us. Come and speak to H&R Block, and we'll give you the guidance that you need. So deductions. Obviously, I want to spend a bit of time talking about deductions because they can potentially feed into a much larger refund at the end of the day. So the general rule is that if you spent something for work and you haven't been reimbursed by your employer, then you can claim a tax deduction. Now, the ATO do say that you need to be able to prove that you spent the money. So you need to have some form of proof that you've actually spent the money. So a receipt or an invoice, or potentially a bank statement if that identifies that the expenditure was work related. So now is very much the time to gather together all of your invoices, receipts, etc., ready for the 1st of July, ready for when you do your tax return. You don't want to get into doing your tax return. You think you may have had a deduction for whatever, but you can't find the receipt or the invoice. Get that information before you do your tax return, and it'll make the whole process much easier. The ATO do expect that you will have kept substantiation. So if you haven't kept substantiation, or if you can't find the substantiation, then even if the expense was otherwise deductible, then really you can't claim it. So it is worthwhile taking the time to find that receipt or invoice. If you spent something partly for work and partly for private use, then you've got to apportion the cost. So if, for example, you use your mobile, you've got one mobile phone, which you use for work and for private use, and your monthly bill is $100. You use the mobile phone 25% for work purposes and 75% for private purposes. You can claim a deduction for $25 for that bill. Now, the things that you could claim, there's a long list of them. They're on the list, they're on the slide there. I'm not going to go through them all. You can go through them at your leisure. Some of them will not be applicable to you. Some of them might be applicable to you. That just gives an indication of the types of expenses that you can actually claim. And you know, it's a very long list. So make sure that you spend the time to go through that list and see whether you're actually going to be entitled to that deduction. And that list, incidentally, isn't by any means complete. That's simply a list of the common deductions that people can claim. So it's worthwhile talking to your tax agent to find out about the things that you personally could be eligible for. I want to spend a bit of time talking through specific deductions which are going to be of interest to you. So let's start with self-education costs. You can claim expenses for university or TAFE fees to the extent that the course relates to your current employment and you aren't being reimbursed by your employer. So, for example, a personal trainer could claim for the cost of doing a Bachelor of Exercise Science. In addition to the course fees, you can also claim any associated costs, such as textbooks or travel or stationery or working from home expenses. Whatever that is, you can claim it. In addition, professional development as a fitness professional, you might well need to undertake some professional development to keep up to date with the latest practices, such as completing CEC courses or attending events like FileX. So those costs are also going to be deductible to the extent that they are linked to your current job. If you, for example, undertake a course and it isn't related to your current job, so for example, it might be necessary to get a promotion, but it isn't strictly limited to your current job, then you can't claim a deduction. In addition, you can't claim a deduction for pre-vocational courses, such as a Certificate 3 in fitness. So that's the sort of course that you do before you get a job, and therefore it isn't a work-related expense, so you can't claim it. Work-related clothing. Obviously, everybody likes to claim for the clothes that they wear to work, but that's not always possible. So, for example, I occasionally wear a suit. However, that is not a deductible item of work-related clothing. Basically, you can claim a deduction for clothing that you're required to wear as a uniform to your place of work. If it has the logo of the gym or the facility or the sporting club where you work on it. You can't claim a deduction for normal clothing, what we term conventional clothing, even if your employer tells you to wear them. So, for example, if you are wearing normal sports clothing, you can't claim a deduction for that, even though you might be obliged to wear that normal sports clothing, because that simply isn't categorized as a uniform. So, general exercise clothing like, tracksuits or shorts or tank tops, running shoes, socks, t-shirts, etc., can't normally be claimed. Anybody who works outside, so for example, maybe you do fitness classes outside, well, you can claim the cost of sun protection gear. So such deductions as sunglasses, hats, sunscreen, etc. Now, travel and meals. Well, first of all, let's make one thing absolutely clear. You can't claim the cost of the daily commute to and from work. That is regarded as a private expense, so that is not categorized as a work-related expense. The exception to that rule is if you have to carry some form of bulky equipment. So, for example, an inflatable exercise ball or some other form of exercise equipment to and from work, because there's no secure place of storage for them to be kept at your workplace. Do make sure that you meet the rules if you intend to rely on that exception. So if you, for example, choose to carry the bulky equipment, but actually it could easily be stored at work, you can't claim the deduction. What you can claim is the cost of traveling between two workplaces, such as, for example, two gyms or two personal training appointments. And that includes not just the car transport, but also public transport and taxi costs. So if you do plan to use your own car for work purposes, then you can either claim the ATO's set rate, which is currently 72 cents per kilometre, for all your work journeys up to 5,000 kilometres, or you can claim the actual expenses that were incurred. Now, if you choose to use the actual basis, then you do need to keep receipts for all costs, and also keep a logbook of all your journeys for a 12-week period. That logbook doesn't need to be kept every year. It can be kept basically once within a 5-year period, and it's good for the whole of that 5-year period. The completion of the logbook is a bit of a pain. It is quite arduous, but as I say, it does only need to be completed once in 5 years. It is worthwhile though, because otherwise you are restricted to claiming the ATO set rate, which is 72 cents per kilometre, and that is only claimable for 5,000 kilometres. So even if you did more than that, then you can only claim 5,000 kilometres. Just because you're in the fitness or sporting industry, it doesn't give you a golden ticket for claiming a tax deduction for the cost of attending sporting events. So don't think that you can claim for that ticket to the grand final or whatever. If you are working interstate, the cost of the flights is potentially tax deductible. When it comes to claiming meals, you can only claim those if the expense is incurred due to your being away from work. And also the same applies to accommodation and incidental expenses. Now, working from home, this is something that I'm sure we've all got used to over the last year or so of COVID. If you work from home, you can claim a tax deduction for the work-related proportion of certain household costs. So, for example, heating, cooling, and lighting bills, the cost of cleaning your home working area, a depreciation of home office furniture and fittings, depreciation of office equipment and computers, the cost of repairing all of that, small capital items such as furniture and computer equipment costing less than $300. They don't need to be depreciated. They can be written off in full immediately. Computer consumables such as printer ink and stationery, and also the telephone costs, your mobile phone or your landline, and your home internet expenses. So a proportion of all of those costs can potentially be claimed for working from home. Now, the ATO gives you a choice of which method to use. Basically, there are 3 methods. There's the shortcut method, which is a flat rate of 80 cents per hour. That covers all of those potential claims which I've just talked about. You can't claim anything else. All you can claim is the 80 cents per hour. As an alternative, you can claim 52 cents per hour. That might not sound as attractive. However, that does exclude phone, internet, and depreciation of equipment and computers, which can all be claimed separately. And typically, when you claim the 52-cent rate and then make the separate claims for all of those other items, that generally produces a much higher deduction than the 80-cent per hour rate. The best way of claiming in terms of the size of the actual deduction is to claim actual costs. However, that's a bit of a pain from a record keeping perspective. First of all, you need to keep a 4-week diary to work out what the work-related and private split between your work expenses actually is. And you also need to keep detailed substantiation. So all of the receipts and the invoices for all of the particular items that you wish to claim. So actual costs does produce a decent deduction, the best deduction generally of the 3 methods, but there is a great deal of record keeping and substantiation needed to be able to claim it. Now, there are quite a few deductions which are unique to, really pretty much unique to the current environment. So the list of COVID-19 related tax deductions is suddenly quite relevant. In the past, nobody bothered about any of this stuff, but now in a COVID-19 world, this is quite substantial, can lead to quite substantial claims. So you could be able to claim the cost of personal protective equipment if it's a requirement of your job that you can't socially distance or your business requires cleanliness. So that includes things like antibacterial soap and spray, hand sanitizer, face masks and shields. So all of that kind of COVID-19 protection is all potentially deductible. At the bottom there is a list of types of businesses and the types of individuals who may be able to claim. Obviously, it includes fitness staff and gym owners, so you could well be able to claim the cost of all of those if you actually incurred the expense. COVID-19 tests are also tax deductible where they're purchased for work-related purposes. That came in from the 1st of July 2021. It was recently, the law was changed, but it was backdated to the 1st of July in this current tax year. So if you've gone out and bought a rat test, then that will be deductible where it was purchased for work-related purposes. So, for example, in a situation where there's a mandatory requirement under an employer's COVID-19 mandate, you would be able to claim a deduction for the rat test. In addition, COVID-19 tests may be required when you're traveling overseas or interstate for work purposes, and that too will be tax deductible. Where you've purchased a COVID-19 test for private purposes, so for example, personal travel interstate or overseas, your own personal convenience, where there's no access to PCR testing, that won't be tax deductible. If you incur transport expenses to get to and from the site of a COVID-19 PCR test, or indeed traveling to the chemist or supermarket to acquire a rat test, then that won't be tax deductible because the ATO says that they are regarded as private expenses, even if the test is a condition of your employment. Now, you may be able to claim depreciation on any assets that you purchase to use in your job. So, for example, things like your mobile phone or laptop computer or tablet computer, home office furniture and equipment, fitness equipment, whatever. You can claim depreciation on any assets that you use in your job. Depreciation is where you claim the cost of the asset over several years, over the effective life of the asset. So you don't get the deduction all in one go in the current tax year, but you instead spread it out over a period of several years. Just remember that some of those depreciation items are potentially included in working from home costs. So if you're claiming, for example, the 80-cent rate, that includes depreciation already. You don't have to separately calculate that. Whereas if you're claiming the 52-cent rate, possibly, and the actual rate, definitely, that doesn't include depreciation. So you need to sit down and work out the depreciation on those assets. It can be complicated, but definitely best to talk to a tax agent. If you purchase a capital item which costs less than $300, then you can claim the whole amount immediately. It doesn't need to be depreciated. Now, I've just talked through the various things that you could potentially claim. However, I think it's useful to spend a bit of time talking about what you can't claim, because these are some of the common expenses which people think are tax deductible, but actually are not. So, for example, the daily commute to and from work, I spoke about that on the travel expenses slide, but nevertheless, it does bear reiteration that the daily commute to and from work isn't tax deductible. Childcare fees, club membership fees, including usually, but not always, gyms, the cost of attending social functions, your driver's license, any fines which you incur, even while you're on a work-related journey. So you might be traveling from one fitness venue to another. So that might be a work-related journey. But if you get a speeding fine on that, then you can't claim it because that is regarded always as a private expense. It's not work related. Glasses and contact lenses aren't claimable. In addition, if you're working from home, then you can't claim for the costs of ownership of the property. So things like your rent or your mortgage or the rates or the insurance or whatever, they are not deductible when you're working from home. They are deductible if you've got a home business, but I'm assuming that that won't be the case for most of the people on this presentation. A bit more about gyms. Lots of people think that they can claim a gym membership because they're in the fitness industry. Basically, they probably can't. The ATO does take a very hard line on gym memberships. The criteria is that they're only claimable where the person claiming them needs to have a level of fitness which is well above normal. Now, the ATO does give some examples of who can make a claim. So professional sports people are listed as an example of who can make a claim. Personal trainers and fitness instructors are specifically ruled out. So probably most of the people on this presentation won't be able to claim gym memberships. Record keeping, I mentioned earlier on the importance of record keeping. It's vital that you keep copies of everything that you that you want to claim, so receipts or invoices, etc. However, they don't just need to be kept for this year, they need to be kept for a period of at least 5 years, because the ATO can potentially come back and audit you in a future year. They can ask to see that supporting documentation, and if you don't have it in relation to this year, then potentially you could find yourself in trouble. So you must keep records to support your income tax lodgements for a period of at least 5 years. So examples of what I'm talking about in relation to your income, payment summaries or income statements, records of investment income, and in relation to expenses or purchase records, things like receipts, invoices, or credit card or bank statements. Now, if you earn less than $126,000 this year, then you could well be eligible for the low and middle income tax offset, as you probably were last year. However, this year, the low and middle income tax offset has been expanded somewhat, so you basically get more than you have in previous years. So if for example, you fall into the category of earning between $48,001 to $90,000. Previously, you would have been able to claim $1,080 offset through the low middle income tax offset. In the last budget, that was increased to $1,500. So basically, you'll be getting an extra $480 because of that, and that will flow through typically into an additional refund when you lodge actually your tax return. So everybody who is entitled to the low middle income tax offset is going to get that $480 tax boost. So if your income is, for example, $37,000 or less, so you're on the minimum scale of this. Previously, you would have got about slightly less than $200. Now you'll get $675. So basically, everybody will get $420 extra in relation to the low middle income tax offset. However, the tax offset does actually cut out at $126,000. So if you earn $126,001, then you won't get anything. But if you're in that range between 37,000 and 126,000, this is well worth having. As I say, you only get the offset when you lodge your tax return, so that's a bit of an incentive to lodge your tax return early. Now, just briefly, I'll just talk about small businesses. I'm not sure whether anybody here is actually running a small business or whether you're all employees, but nevertheless, I'll just flag a couple of issues which are relevant to small businesses. If you're trading through a company, your tax rate will have gone down to 25%. It actually went down to 25% on the 1st of July last year, so it's already 25%. It won't change this year. And if you're running a unincorporated business, so for example, if you're running a sole trader, then you will receive the small business income tax offset, which can reduce the amount of tax that you pay by up to $1,000 each year. The main thing to talk about for small businesses, however, is the tax break for capital assets. So temporary full expensing is actually called. I talked about depreciation for employees earlier on. So what that means is that basically you write off the cost of capital assets over the effective life of the asset. So that's the case with employees, but with small businesses, the temporary full expensing scheme enables you to buy capital assets and basically write off the entire cost in year one. So from a cash flow perspective, this is a really good incentive. So if you're buying a new, for example, a new computer or a new car, even potentially, or some new fitness equipment, which is going to be categorized as capital, then you can write off the entire cost against your assessable income in year one. So really valuable incentive. This runs out on the 30th of June 2023. So you've got to take advantage of it really over the next 12 months because then basically the scheme will stop and the threshold will actually, or the threshold will be reintroduced and it will go back down to $1,000. This full expensing scheme does apply to new assets. However, if you're a small and medium-sized business, which basically, I assume, if anybody's listening to this, you probably are. So, you've got annual turnover of less than $50 million. Full expensing also applies to second-hand assets. So there's a typical list of things which you could potentially claim, fixtures and fittings, technology items such as gym machines, laptops, computers, FPOS systems, security equipment, motor vehicles such as utes, delivery vans, and most cars. The amount that you can claim for a car is currently restricted to $60,733. That will go up on the 1st of July to about $64,000. So that's quite a generous sum. You can get quite a decent car for $60,733, and the entire cost can be written off in year one. Not every asset is eligible. So expensive cars, so cars which are over that threshold, you can only claim up to the threshold, not the excess. Buildings, other assets that are eligible for capital works deductions, that's 4% depreciation. So if you're actually going out and buying a building, you can't claim that. Assets located overseas, etc. I won't spend too much time talking about those two slides because they're probably not relevant. But yeah, that's a quick roundup of the situation for fitness employees as we head towards the tax return lodgement date. That's the end of the presentation. Obviously, I'm happy to take questions if there are any.
Thanks, Mark. There was actually a few questions in the chat box, and there was a few I think went into, sorry, there's a few questions in the Q&A box, and I think a few questions also went into the chat box, if you can put those in the Q&A. So just starting with Luke, what is the amount that an invoice receipt is required? I've heard up to $90, nothing is required.
That's not correct. If you are claiming a tax deduction in your income tax return, then basically you need an invoice for everything. So no matter how insubstantial the expense, then you do need an invoice or a receipt. If you're actually issuing invoices, then if the transaction is greater than $75, you do need to give an invoice. However, I don't think that's what Luke is actually getting at. If it's in relation to deductions, then you do need an invoice for everything.
Thanks, Mark. So Erin's also asked, how do you claim for travel? How many cents per kilometre? Now, petrol's really gone up this year. I think you've answered that, but maybe you just need to address that again with the...
Yeah, so you can either claim 72 cents per kilometre for the current tax year, or 75 cents per kilometre for the next tax year. Obviously, that's not relevant for this tax return, but when you come to do next year's tax return, the amount of cents per kilometre has gone up to 75. That is intended to compensate people for the increase in petrol. It hasn't really, well, obviously, it hasn't come close to compensating for that. The 75 cents was set probably about 3 or 4 months ago, really before the petrol increase took off. The ATO hasn't shown any inclination to increase that rate. And certainly for this year, then it is 72 cents per kilometre, and only for the first 5,000 kilometres of business travel. If you do more than 5,000 kilometres, then either you can claim the cents per kilometre rate up to 5,000, or you claim the actual costs with all of the administrative burden that comes with. But not really any relief there for the increasing cost of petrol.
Thanks, Mark. If an item costs exactly $300, can it be claimed immediately or only under $300, for example, $299?
Yeah, if it's under $300, it can be claimed immediately.
Okay. Is it correct that you still need to keep any property contacts or contracts in play for 7 years?
That is covered by the normal record keeping rules. So basically the period that it needs to be kept for is 5 years, not 7 years.
Thank you. What is deemed, from Lauren, what is deemed acceptable evidence for subscriptions, e.g. group fitness, music online subscription is $25 a month? They don't actually issue a tax invoice. Is a transaction on your credit card deemed adequate evidence?
It is certainly adequate evidence that you spent the money. Whether it is adequate evidence that it was spent on a work-related purpose is another question. So I can't really answer that, but potentially, yes, it is sufficient evidence. It does prove that you spent the money, but you might need to justify that in terms of whether it was actually work-related or not.
Thank you. And also, if there's any international transaction fees involved in that music online subscription, are they tax deductible as well?
Yeah, if the initial subscription is tax deductible, then any international transaction fee which is linked to it will also be deductible.
From Mary, how do we roll or go, I assume, if we are employees and sole operators?
Well, basically, you have to complete the employee section of the tax return. You need to declare all of your income there and all of your expenses there that are work-related. And you need to complete the business section of the tax return as well, containing your business income and deductions. So, yeah, it's effectively 2 sections of the tax return that you need to complete there.
Are any of the payments under JobKeeper or COVID-related payments during lockdowns taxable?
Yes, JobKeeper is. There are lots of different COVID payments. It is very difficult to work out whether they're taxable or not. Basically, JobKeeper is some of the state-based payments that people received by way of compensation have actually been made non-deductible. Having said that, there is quite a prescriptive list of which ones are going to be tax-free and which ones are taxable. So it's very definitely worth speaking to your tax agent. Speak to H&R Block and they'll be able to tell you whether the COVID payment that you've received is taxable or not. Well, basically, JobKeeper is taxable.
Thanks, Mark. From Nathan, how does writing off a vehicle work? If the cost of the vehicle was $10,000, what would happen during your tax return? Would this reduce your taxable income, or is it based on the profit of your business?
Well, it would reduce the profit of your business. So the entire cost of $10,000 is deductible if this is somebody that's in business. So if you had $100,000 of business income, you then knock off the cost of the vehicle of $10,000, and that then gives you a net profit, which will be taxable, of $90,000.
Okay, from Brian, is a franchise fee deductible at all?
If it's the cost of renewing a franchise, then probably yes. If it's the initial cost of setting up the franchise, then probably no.
Okay. From Lauren, with regard to rent, a sole trader running their business from their home, which they rent, is able to claim a portion of rent. Is that correct?
Yes, provided you are actually running your business from home. That is correct. Yep.
Okay. Again, another Lauren, can you claim equipment such as a fitness watch like Fitbit or that sort of
Look, if you use the Fitbit in your job, then it's the same rule that applies to any form of equipment. So yes, if it's used within your job, but you're probably going to have to allocate the expense between private use and business use.
From Amanda, will we be sent these slides after the presentation?
Oh, I assume so. I emailed them to Luke, so I assume they'll be available to everybody afterwards.
Yes, in that case, Amanda, they will be. From Mark, previously you could claim travel between primary work office and fitness work location. With the move to work from home due to COVID, can you claim between home office and fitness location?
That's an interesting one. Probably yes. I would say to that. That's not. Yeah. I'd need to think about that one, but the answer to that is probably yes.
Last one in the box, Mark, from Mary. I got a call from the ATO, supposedly asking me to complete my tax return for 2003. Is this a scam or is it for real?
It could be real. I mean, there are. It's fair to say that there are a fair few scams around at the moment with people phoning, claiming to be from the ATO. But I mean, potentially the ATO can ask you to complete any tax returns that you haven't lodged. So if you haven't lodged 2003 one, they could well be on your case. Absolutely.
Okay. Well, thanks, Mark. That's the end of the questions in the Q&A box. As you, hang on, just I'm going to come in. From Mary again, this relates to 2003. Since you said you can track back or need to keep your records for 5 years, so I guess Mary's implying I don't have any records for 2003.
Yeah, but at the end of the day, the ATO can get you to lodge any unlodged tax returns. So if you had one for 2003, which was due, and you didn't lodge it, then potentially the ATO can actually ask you to lodge that now if they've only just realised. Yeah.
Okay. So really interesting answers, really complex questions. I think the bottom line here, or the moral to the story, is if you're in doubt, seek professional advice. And the professional advice, as you indicated, Mark, is the tax deduction in its own right.
Absolutely.
It relates to tax and super, etc. Also, for those people who are on this webinar, you may or may not have received advice from AusActive that as of the 1st of July, our membership fees will be increasing. They will not be going up to pre-COVID levels, but they will be going up a little bit from where they currently are. However, you have the opportunity, if you wish to advance purchase up to 2 years of your membership fee at the current rates. So just pass that on to you. So thanks again, Mark, really informative. I've actually been taking notes from my own taxation. The COVID stuff particularly is very relevant and topical. And I think I hadn't even given any thought to that, to be quite honest, being able to claim RAT tests and things like that. So fantastic session, really informative. I really appreciate giving up your time freely for us. The slides will be available after the session. Thanks again, Mark, and have a lovely weekend. And goodbye to all our participants as well. Thank you.
It's a pleasure. Thank you.